What if you wanted to own a slice of some of your favorite stocks, but the price tag associated with owning all of them at once can be rather hefty at times? Luckily, there is a workaround. Let's demonstrate this in a real-life example. These ingredients on their own may taste unremarkable and they don't make up a complete recipe. But as you start to combine them, they can create some of our favorite recipes like cake, cookies, or pie. Now, let's say these baking ingredients represent different stocks. Butter can be Tesla, salt can be Apple, the eggs can be Nike, sugar is Amazon, and flour is Walmart. Just like these ingredients for pie, the same can be said for stocks. Stocks can stand alone, but they're oftentimes better in groups or indexes. But how can you easily invest in indexes or entire economic sectors when the price of individual stocks can easily add up to thousands of dollars? As we'll see, the answer to all of these questions are 3 little letters: ETF. Hi, I'm Sarah at Stockcharts, and today I want to tell you all about ETFs and how they can turbocharge your investing. In order to fully understand why ETFs are so great, we need to go back in time, to a time before ETFs ever existed. Back in the 1960s and even earlier, investors could only buy and sell stocks on the stock market. In those days, if you wanted your portfolio to track the Dow Jones Industrial Average, you need to buy shares in all 30 Dow companies. And if you wanted to track the S&P 500, you'd need to acquire and manage stocks from all 500 companies. Can you imagine what a hassle that would have been? Then, in the 1980s, investors started getting access to index-based mutual funds that tracked popular indexes. But mutual funds did come with frustrating restrictions. For example, you could only buy and sell them after the market had closed. They only had one single price data point per day, and that was reported after the close as well. And many mutual funds had large management fees associated with them. So, then in the late 80s, exchange-traded funds, or ETFs, were introduced as a way to get around many disadvantages of the index-based mutual funds. As we'll see, since they were introduced, ETFs have proven to be very popular amongst modern investors. An exchange-traded fund, or ETF for short, is a collection of stocks that are traded exactly like individual stock. Each ETF has its own criteria for selecting its collection of stocks, as well as the formula used to determine the ETF's price. Index-based ETFs track common market indexes like the Dow or S&P 500. Those ETFs simply copy the stocks and formulas used by the people that publish the underlying index to determine the ETF's value. For example, let's say I'm a manager for an ETF that tracks the NASDAQ 100 index. To ensure that my ETF tracks the index correctly, I'll have to buy those 100 stocks in the exact same proportions as the index weighting formula. And then I need to make sure that when those stocks are added or removed from the index, they're also added and removed from my ETF. If I do those things correctly, when the index moves up, for example, let's say 3%, so should my ETF. From an investor's perspective, an ETF is an affordable way to invest in a collection of stocks without having to buy all of them individually. In addition to buying ETFs that are based on indexes, you can also buy ETFs that are based on sectors, industries, asset classes, you name it. There are thousands of ETFs to pick from, and each has its own approach. And just like stocks, you can buy and sell an ETF at any time. You can watch their price change minute by minute, and you can see the ETF's trading volume throughout the day. Plus, unlike stocks, when you buy an ETF, you don't become a shareholder in the underlying companies. You don't get a say in how they run their companies either, nor do you directly receive any cash dividends those companies may distribute. But many investors don't care about that aspect of stock ownership. Many investors just want to profit by having their holdings increase in price, and ETFs are perfect for those kind of investors. And the really good news is those shareholder type issues are the only differences. Again, in general, ETFs work exactly like stocks, and that's their main benefit. You can buy or sell them as often as you want whenever the markets are open. Like we talked about earlier, there are thousands of ETFs to choose from. So how do you decide which one you want to follow and possibly purchase? Let's start by first looking at some of the most popular ETFs out there. But first, here's a tip. One of the best places on the web to review popular ETFs is Stockcharts.com under their Market Summary page. To see this page, go to Stockcharts.com and click on the Charts and Tools tab. Then, click on Market Summary to the right of the sidebar. Finally, and this is the most important part that not everyone knows, select ETF from the drop-down at the top of the page. On that page, you'll find all popular ETFs conveniently grouped into categories like major markets, US industries, and international ETFs. You can then click on any ETF you see and then see that chart instantly. Okay, with that tip in mind, here are some of the most important ETFs you need to be familiar with. Containing all 500 stocks that make up the S&P 500 large caps, SPY is one of the most popular ETFs out there. It's a great ETF to own because its underlying index is generally considered to be the benchmark for the entire stock market. And that means that SPY's performance will always match the market. So, by owning SPY, you won't outperform the market, but more likely than not, for long-term investors, you also won't underperform it either. The performance of the QQQ, also called the Qs, is based on the top 100 stocks of the NASDAQ exchange. These are typically 100 of the biggest names in the technology sector. Stocks like Google, Apple, Microsoft, and so on. And because these technology stocks historically outperform the market, QQQ is a popular ETF choice amongst aggressive investors. However, QQQ can also be more volatile than other ETFs, which can cause a lot of stress. So, remember, in investing, you have to get bigger rewards by taking on more risk. Abbreviated as DIA, it's also referred to as the diamonds, and it matches the performance of the Dow Jones Industrial Average, one of the most widely followed stock market indexes. If you want an easy way to own the Dow, DIA or diamonds is the right ETF for you. The Russell 2000 is a popular market index that tracks the top 2,000 small-cap stocks in the market. Many people have noticed that, historically, small-cap stocks can turn before the general market, making them a really good leading indicator for future stock market performance. By mimicking the performance of the Russell 2000 index, the IWM ETF lets you invest in small caps as well. Plus, it's a whole lot easier than buying and selling 2,000 individual stocks. Can you imagine managing that? Next are some of my favorite ETFs. The S&P Select Sector ETFs, also known as SPDRs, or as most people call them, the Spiders. The Spiders are a collection of 10 related ETFs that track the major sectors in the market. Sectors like technology, financials, consumer discretionary, etc. These ETFs let you invest more actively in the market, concentrating your portfolio in areas that you think are going to do well in the next coming weeks or months. Many people that invest in these ETFs use the theory of sector rotation to help guide their choices. And that brings me to another great tip, the Stockcharts Sector Rotation Perf Chart. The Sector Rotation Perf Chart lets you see how the spiders have been doing relative to the S&P 500 and each other. To see a live version of this chart, simply go to Stockcharts.com and click on the Charts and Tools tab. Then, locate the Perf Charts card in the middle of the page and click on Predefined Groups. Then you can select S&P sector ETFs. The theory of sector rotation states that different sectors outperform the market at different points in the overall economic cycle. For example, at the start of an economic downturn, utility stocks tend to outperform the market since investors will often buy bonds in uncertain times. To help you better understand sector rotation, we've included a diagram underneath the perf chart that shows you which sectors do well at different points in the economic cycle. To use the sector perf chart, check to see if there is a collection of adjacent sectors that are outperforming the market. So, if you think that the economy isn't going to change anytime soon, then you can invest in those ETFs. On the other hand, if you think the economy is going to change soon, you should consider buying the ETFs to the right of the current bars. This is because, according to theory, they should outperform the market soon. Again, this is all just a theory, and you do need to do more research before putting your hard-earned money into the ETFs. But I do find it fascinating how ETFs can predict the future. When is a stock not a stock? It's when it's a bond-based ETF. TLT is an ETF that behaves exactly like a 20-year-old treasury bond. By buying and selling TLT, you can actually diversify your portfolio without the hassle of buying actual bonds themselves. Bonds often become popular when stocks move lower. As stocks become less attractive, investors look for other, less risky things to invest in, and bonds, especially the US Treasury bonds, fit that bill perfectly. So, when stocks are moving lower, TLT tends to outperform. Just as we saw, one of the great reasons for buying an ETF instead of a stock is that ETFs can actually help you target your investing in an area of a market that you're interested in. Want to invest in the tech sector? Buy QQQ or XLK. Want to invest in gold? Buy GDX, and so on. Viewed in this way, ETFs have opened up a wealth of new opportunities for investors. And frankly, it's very hard for me to even imagine what it was like before ETFs ever existed. Another thing to consider is that ETFs will automatically update themselves as their underlying indexes change. For example, let's say that the people who control the Dow Jones Industrial Average decide to remove an old company from the index and add a new one. If you are tracking that index with a portfolio of stocks, you need to make those exact same changes on the exact same days that the index makes them as well. And that's way too much work. On the other hand, if you just owned a diamond, you wouldn't need to do a thing. People that manage diamonds would do all the work for you. This is the best part of all. To invest in an ETF, simply buy it and sell it like you would any other stock. There are no restrictions or special qualifications necessary. ETFs are just like stocks when it comes to buying and selling them. Easy peasy. The only downside to ETFs is that there are now thousands to choose from, and it can be a little bit overwhelming when trying to decide what to buy. The bad news here is that you will need to do some research on your own to fully answer that question. The good news, however, is that the web has tons of resources that can help you, including all of the free information on ETFs at Stockcharts.com. I recommend browsing through the overview section of the Stockcharts.com chart school. You might find an article on asset location particularly helpful. In addition, make sure you check out the most recent blogs on Stockcharts' articles section. Our bloggers are constantly updating their readers on various ETF opportunities as they arise in real time. As you saw on the market summary page that I showed you earlier in this video, ETFs can also be used as substitutes for their underlying indexes. Let's say that you want to track the Russell 2000 index, but you don't have access to that index's data. Well, simply track the IWM instead. While the IWM actual value is different from the underlying index's value, its performance, in other words, its percentage change, will always match the underlying indexes perfectly. ETFs give investors many more options for managing their money. They allow you to invest in a group of stocks just as easily as a single stock, and they don't come with any restrictions or burdensome management fees. And there's now a huge universe of ETFs to pick from, each with its own focus and strategy. ETFs are the easiest way I know of to implement a powerful, diverse trading strategy for your portfolio that, if done correctly, can grow your investments regardless of market conditions. Investing in ETFs can be as easy as pie. We've taken our collection of ingredients and transformed them into something delicious. Now we can enjoy some of our favorite ingredients or stocks all in one bite. I'm Sarah from Stockcharts. See you in the next video.